you hear don't fight the Fed, which is true, but don't fight the IRS. I mean, the IRS code is set up as a series of incentives and disincentives to change human behavior. And it is very clearly structured to incentivize you to own your own home and to invest in commercial real estate. So go with it.
All right, everybody, welcome back to another episode of The Richer Geek. Today's podcast, we have Brian Adams, who's the president and founder of Excelsior Capital. How you doing, Brian?
I'm good. Thank you for having me.
Yeah, it's very interesting. We're going to do a little bit of a spin on what our normal podcast is. Normally, we bring on people that are actively involved in these little different ways of doing real estate and how they market and how they do this. But tell us a little bit about what Excelsior Capital is, kind of the history behind it, and where you started at and what you're doing now.
Yeah, happy to. So I'm a New Yorker who married a Nashville girl. So I've been in Tennessee for 15 years. I met her in college, did the Northeast thing, went to law school up in Boston, practiced law for a couple of years, and had the huge benefit of obviously marrying my wife for a lot of reasons. And one of them is that her family has a family office, which I think we'll probably get into later in this conversation about what they are, what they aren't. Mm-hmm. It's kind of become a buzzword.
Yes.
In a lot of ways. And I think it's really misunderstood. But in any event, because I joined the board as an ex officio member, I started getting exposure to all the investments we were making with various sponsors and GPs and funds, et cetera, and fell in love with real estate as a asset class, as an investment vehicle, connected with my partner, who's also an attorney by trade. And we started the company 10 years ago. And so started raising small commingled blind pool funds, which I think your audience is probably pretty familiar with how they function. That was probably a big mistake looking back on it, frankly. I think funds are an imperfect vehicle and suboptimal for a lot of our investors for a host of reasons, but that's how we got into the business. About 6 years ago, we started offering up direct co-investment opportunities to our fund investors as sidecars. And that's really when we expanded pretty significantly because they started bringing in their friends and family on purely a deal by deal basis. So we pivoted towards a direct syndication model where we raise capital deal by deal. And we can get into kind of what we do. But to set the perspective and the framework, today we have 15 employees. We're based in Nashville. We have about 2.5 million square feet under management in 12 markets. And that's about a $400 million portfolio of 35 some odd assets.
In a not very long period of time. So that's very impressive. It's wonderful.
Yeah. Made a whole bunch of mistakes.
Yeah. Well, and we'll get into that. It's before we get into that, the fact that you said one of the mistakes was doing a direct funds. Now, during COVID, and with me being in the hotel business, I can't sit there and say, "Hey, everyone, these assets now that did not make it during COVID are now going to go to auction. I need money fast." I also do the syndications, but for our investors out there that are sitting there say, "Well, I thought the way that we should have done it is, hey, I need all this money, 3 million, 5 million, 10 million, whatever it is, just pull it together, then wait for something to come up." Instead of a specific type of asset, we're going after this office or we're going after this hotel. Is that how you're seeing it now, or you just have enough people in your backlog in a fund that then you can then turn into a syndication?
Yeah. So the issue with a fund is, and again, I can only speak to my investor base, right? These are my experiences. A fund is a great vehicle for a set of investors. It's a great vehicle for certain investment types and certain return profiles. It just is not a great fit for us, who we work with and what we do.
Mhm.
And part of that is because if today we were deploying out of fund 4, right? We raised 3 funds in the past, we would be beholden to that fund PPM
Mhm.
and really just focused on, suburban office product in secondary markets, which our portfolio has held up really well. We've been able to make distributions. I'm a big believer in office. We can get into that if you want. But underwriting an office deal today is very challenging from, a lease renewal probability and new leasing momentum. And so, and frankly, there's been no distress in that space. Secondary suburban office cap rates have gone down
Mm.
if from COVID. And I see the deal flow. So to deploy capital to that space and be beholden to that PPM and that specific investment thesis, it just means that you can't deploy capital.
Mm.
And where we see opportunity today is elsewhere. And so from that perspective, I think a fund is suboptimal
Mm.
when you want to move quickly. And frankly, we're at a place where we have enough investor relationships and we've had great LPs that, they come along with us for the most part.
Mhm.
And that affords us the ability to, go where we see value today, which, is for the most part in kind of this industrial single story flex product type. And again, we're trying to solve for 3 things. And I think this is also the reason that the fund is not a great fit for us. We are not out there hunting big IRR. We are not 2 to 3 year holders, the kind of buyers that when they buy something, they hate it the next day.
Mm.
We are long-term yield focused
Yep.
investors. And when you're chugging along at a double-digit cash on cash yield, you don't necessarily want to have a fund of those product types, because if the product is performing,
Mm.
I don't want to have a set timeline where the only way that I get paid my incentive is when I sell my last asset.
Yep.
Because, you're a fiduciary, but at the end of the day, if it means you're going to get your carried interest, you're going to sell that asset. Whereas deal by deal, I listen to my investors, and if it's continuing to perform, if it's continuing to cash flow, I have other carried interest hitting in other locations, and
Mhm.
it just feels like the right fit for who we are and what we do.
Yeah, it makes sense. Now, something I always like to hit on, because, oh my God, there's too many people that they get their start in doing what we're doing by watching HGTV, right?
Mhm.
And they think they can make money in an hour episode. Um, and I keep pinpointing that, look, um, even though I am now at this point where we're doing syndication, we have this many millions of dollars in our portfolio. I stunk and I burned it at the beginning. And it's those types of things that have really, really taught me how to become a good syndicator, a good person who finds the assets. I don't care about everyone, because everyone and their brother on LinkedIn and everyone's saying how wonderful they are. Um, what have you learned? Talk to us about some of the things that you just said there. It's like, man, this stunk, but I really learned the hard way. I learned from that lesson. And
Yeah, it's a great question. And to your point, I think there's a lot of people running around on LinkedIn saying that they're sponsors and that they're doing these multifamily deals.
Mhm.
And time will tell, right? I mean, the numbers don't lie. As my hockey coach told me growing up, tape don't lie. We'll see what the tape says. But I will say that the biggest mistake or risk that I see in the investment space today for fundless sponsors, and one that LPs do not ask enough questions about, in my opinion, when they're doing diligence on a sponsor, is the fact that the real estate deals have to make sense, right? I mean,
Mhm.
your investment theory, your thesis, your execution, your underwriting, et cetera, your technical abilities to find good deals, manage those deals, and exit those deals has to be great.
Yeah.
But there's this whole other risk that I think is hugely underappreciated, that these people, even if you are a small fundless sponsor, you are running a small business.
Mm.
And that small business has really nothing to do directly related to the real estate investments you're making, but it will make or break your company and your ability to be successful. So the biggest mistake I made was, early in my career, was a deal guy. let's go do deals. Let's go raise some capital. Let's go find some opportunities. And the deals were good,
Mhm.
but my infrastructure around my small business was awful. Marketing, reporting, investor relations, HR, tax, audit, legal, the fact that we had an office and we were a tenant, all of these things were put on the back burner. I didn't put proper resources of time and money into them. And I spent about a year, 2 years of my life getting my teeth kicked in by these investors, because even though the deals were doing well, they didn't know about it because I had no reporting mechanism.
Mm.
And I had no way to market everything that we were doing. And so I had to go, to an apology tour basically. And I think ultimately it's made me a much better manager and has allowed me to scale much more efficiently over the last 3 to 4 years.
Mhm.
But it was a very painful experience. I learned about vulnerability. I was reading a lot of Brene Brown. I mean, it was tough, but I had gone from, working in a coffee shop, being an attorney, to having a $200 million portfolio in about 3 years. And it just happened really quickly. And so
Yeah.
I think one of the things that I tell aspiring sponsors and entrepreneurs and also LPs, if they're looking for advice about their diligence, is ask all the questions you want about the deal in, Dallas that the apartment guy's doing,
Mhm.
but ask about all these other things. And what are the expectations, both from your perspective as an investor and their perspective as a GP and sponsor? Because I just think that not everyone really appreciates the amount of time and energy and resources it takes to have the built out small business that allows you to be a real estate investor.
Mhm. Yeah, it's fascinating, and I think everyone's knows that because right now everybody and their brother is coming to me wanting me to invest in their syndication. And I'm looking at these kids and I'm like, us being, a little more seasoned, know the questions to ask. But someone says, yeah, I mean, here's 50,000 and, just give me a return. You say it's going to be 2.5 times, 3 times, whatever, preferred returns. And then, yeah, it's like they never hear, but they know how to find a multifamily place. But all of a sudden it's like they don't know that they need this portal to put all their recordings and all their monthly reports and their accounting, and then they don't have the money to pay for these portals, for their investors. And what I've learned, and I've learned the hard way also, is um, it takes a lot of time to do that reporting and a lot of thought process, when all I could do is monthly synopsis and all of our weekly reports that are done. Most of them are automatic. I have our assistants and our team just load them. Have you found that the automation process, all of a sudden it's like, wow, where you thought that it was going to be so complicated, really gives you a lot more time to focus on the assets and what your strength is, because you have all these automated processes now.
Yeah. I mean, even in the last 5 years, right? I've been in the business 10, but in the last 3, 4 years, the advancements in the prop tech space have been
Hmm.
tremendous and remarkable. And you'll still pay up for quality. We use Juniper Square, you know, as our 24/7, 365 investor portal. And it's not cheap. We have a
Yeah.
lot of investors, so that's kind of a function of that. But
Hmm.
I will tell you, my seasoned investors, they won't begrudge you a bad deal. I mean, some deals are great, some deals are good. There's a spectrum, but they will begrudge you if you don't have institutional quality reporting and investor relations, because it's inexcusable. And it does take a lot of money. It does take a lot of time.
Hmm.
But when you're dealing in the syndication business, I have over 500 investors.
Hmm.
It really does cut down the amount of time that it takes to get on the phone and explain to them what's happening with this individual asset. I mean, even coordinating amongst my various asset managers on whose deal that one is,
Hmm.
getting my controller in the mix and understanding which deals they're an LP in. I mean, all of that kind of goes away because it's an open architecture infrastructure of reporting and communication and marketing standpoint.
Yeah.
And it really has been a total game changer for us.
Yeah, and for our listeners that are looking at doing it, it's very important. Brian had mentioned Juniper Square, which is a very good one. Update Capital is another good one. Um, Spend the money to do the automation because you are dealing with other people's funds. And a lot of times it's all about communication. You know, investors understand that COVID is happening. They understand that things are happening. The returns may not, or might be there, might not. But if they don't hear about whether or not something's going on, then that's when you're going to be a one and done with them.
Yeah, I can tell you from experience that if you just go radio silent, or you have sporadic reporting, or it's just not well thought out,
Hmm.
and and an investor thinks that you're hiding something from them,
Hmm.
their mind will go to the worst possible place. I promise you. And you do not want to experience that. It's a terrible experience. You don't want that type of relationship with your investors, and you can avoid it. And this is what I tell aspiring entrepreneurs and sponsors on the front end is, you're going to want a third party your bookkeeping. You're going to want to outsource your accounting. And I understand you don't have a lot of cash flow. You may not have a lot of capital. It's a very capital intensive business, but I can tell you personally that, we have a CFA level 3. We have somebody who's a master's in real estate. I have an in-house controller who's a CPA with a public accounting tax background, and you'll pay up for that personnel, but it will make your life a lot easier, and it will make your company perform so much better on an execution level.
Yeah, I think that's so important. One of the biggest things that you hit on is when you are a sponsor and you're the general partner, it is so important that to protect yourself. That is your number one goal. Is you want to make money, you want to have funds, but you want to protect yourself. And the easiest way is to say, you know what, I refuse to do my own books. If there's one thing that you have to have is that third party CPA who knows real estate. Don't get your local CPA that just does taxes. Get one that knows the real estate, and my God, get a third party bookkeeper. Pay for those people just so that there's that third party that has responsibility. Because if you get into a syndication, you have a lot of people's money and you are doing everything yourself, then the worst things, all that stuff comes into people's heads. Yeah, that's so important. Great information, Brian. Now, offices is something that, I would not have thought that would be popular now, but, we're seeing here in my area that things are going pretty steadily, but I would have thought that everyone's working from home. Everyone, I'm not thinking that this is a popular play, but you're telling me otherwise, and that's fascinating. So tell me a little bit about what's happening in the office space and what you guys are doing.
Sure. And like a lot of things, there's dynamics in play here. And one of them is recency bias, which we think the way that we live for the last 9 months will be the way that we live for the next 9 years. And that's just never the case. I mean, you've been in the game longer than I have, and it's just not true. The other thing is we're seeing this story about, office and secondary markets and the suburbs where we spend a lot of our time is a story that predates COVID. And our investment thesis is around the concept that this maturing millennial generation, which because of the Great Recession in 2008, had to push back their typical family formation phase 3 to 5 years, had started to get married, have children, and go up against this Wall Street narrative that these people were going to wear skinny jeans and live in Brooklyn and eat avocado toast and never have children for their entire lives. It just was not the case. But that's what kind of the Wall Street was pushing. So what we saw playing out was, especially in Nashville, we saw this anecdotally on the employee side, right? The high net worth individual who was working on Wall Street with 1.5 kids, making over $1 million a year, getting murdered on taxes and having a really poor quality of life, was saying, screw it, I'm going to move back home. What's been more interesting, and this was occurring pre-COVID, but accelerating because of the virus, employers started seeing this trend play out. And they were relocating and planting flags to where they thought the human capital was going to be from a physical standpoint. So this is all kind of taking place in real time, and you're seeing it take place in New York and what's happening in Miami, literally in real time as we speak. And so for office, pre-COVID, 4% of the workforce worked remotely, which is different than work from home. It's important to draw that distinction. Mm-hmm. Do I think in a post-COVID world, more than 4% of the workforce will work remotely? 100%. Do I think it's sustainable to have the massive concentration of employees work from home? No. I think that spike of productivity that we saw in Q2 was because of novelty and people worried they were going to get fired. But as the months have gone on, we've seen burnout, depression, lack of productivity, lack of creativity. Meanwhile, big tech, which is now kind of driving the economy, was picking up cheap office leasing throughout the country because they understand long-term for them to be competitive in the marketplace, they need the best human capital possible. So I think we are going to see a world where people are spending less time in the office, maybe 3 days a week as opposed to 5 days a week. But this massive trend line that we saw towards densification, like in a WeWork location in New York that had 75 square feet per user, the pendulum will swing the other way where it'll be more of a traditional office layout, which is 350 square feet per user. And office will become a place where collaboration occurs, right? Big multi-purpose offices, big conference rooms where you can do that kind of group think or have very quiet time if you don't have your own individual office in your home, if you're a younger person and have an apartment working in your kitchen, et cetera. So all those things taking place, I think it will be a wash in terms of how much square footage is used. And another thing that people kind of don't think much on is if this population is really leaving the coastal markets and going to these places, which I think they are, you've got to be able to park it. And parking ratios in suburban office are usually 4 to 5 per 1,000 square feet. They're really robust. You can put some people in there. Not the case for CBD or downtown areas at all. So I do believe there'll be winners and losers. I would not be picking up office buildings in Midtown Manhattan right now or San Francisco. Unfortunately, I think those markets are places where in order to take care of budget shortfalls, they're going to have to increase taxes on affluent people and cut spending and services, which will create a little bit of a death spiral where they're going to have to continue to increase taxes and continue to decrease services until there's some kind of equilibrium. So I would not be going to the big coastals today. I just think the tax regimes are going to be very challenging, but secondary markets that are experiencing population growth, that have knowledge-based economies where you can still find attractive yields, I think will be a good place to be for the next 5 to 10 years.
Yeah, I agree. Being in Arizona, you're hitting it right on the head. We have so many with Arizona, Texas. I know Tennessee, Nashville is exploding in and around Memphis. These are great taxes, great real estate buys as far as big corporations. You have governments that are pro-business. So those types of, they're moving, there are so many, I see it, people and companies moving out of California into these things because they're just like, we can't sustain. And with your point on the offices, I agree. As a populace, as human beings, we love interacting with people. We miss that one-on-one. We're going to the office, talk at the water cooler, or do whatever it is and that was our norm for so long. And so a lot of the people, even though it's nice working from home, they're at a kitchen table. They're not set up. They don't have homes with offices. And I do believe what you're saying is as soon as people can, they miss that human interaction. They miss going to a conference room. They miss going to an office. So it's very well thought of that. Sometimes we kind of forget because we're concentrating on now. And for someone like me that I work from home 3-4 times days out of the week, I didn't see the change, or the difference. But it's nice having your perspective on why offices are going to sustain. Now, with your syndications and what you're doing now, do you have anything open now, things that you're working on that are listeners who love that passive investment? What are you doing now that might entice some of our listeners?
Yeah, I appreciate that question. As a caveat, we only work with accredited investors, which I think your audience is pretty familiar with the definition.
Yep.
All that being said about what I just kind of commented on office, it's a challenge right now to underwrite office deals because of new leasing and lease momentum, some of the things that I went through, which is why I love being a fundless sponsor. And for us, we're trying to solve 3 problems that we have in our investor base. One is a place to put capital to work that's uncorrelated with the volatility of the stock market or maybe macroeconomic issues that we see playing out. 2, we're solving for that yield, something in that double-digit cash on cash annualized yield. And we only work with taxable investors, so no institutional LPs, which means that we're very focused on the tax advantages that come with direct real estate ownership. And so the ideal is for us to see, a 10% cash on cash yield. And for the first 1-2 years, you're seeing a loss in your K1 that you can offset gains elsewhere in your portfolio. That's kind of what I tell people all the time is you hear don't fight the Fed, which is true, but don't fight the IRS. I mean, the IRS code is set up as a series of incentives and disincentives to change human behavior. And it is very clearly structured to incentivize you to own your own home and to invest in commercial real estate. So go with it. Now that's kind of the pitch, but we're about to launch a deal this week. I'm not sure when this episode is going to air, but it's a single story flex opportunity that's 100% occupied, off market, that we're pretty excited about. It's going to be about a 12% yield, which is pretty remarkable. And we just got our debt quote back, and the debt market is definitely roaring back. There's a lot of appetite there. So we do have an open opportunity as of January 19th, although it's going to launch later this week.
Okay. Yeah. So we're looking at the date. So we're talking, depending on when this will go live, we're maybe the last week of January or so, or around, the 20, towards the end of January, maybe the 3rd or 4th week.
Yeah.
That's fantastic. Now, for our new guys, you're on the board of director of a family office, and that's kind of like the pie in the sky. Everyone says, oh, the family offices, and I saw that HGTV episode where if I do a couple fourplexes, then I can just start talking to family offices, and and I'm sure it drives you nuts because you can't probably sit down anywhere and say, yeah, I'm on the board of director of a family office, and oh, hey, I'm thinking about getting started multifamily. You want to invest with me?
Yeah, please. No more crypto deals, please. No blockchain, please.
There you go. That's hilarious. So, to our listeners out there who may not be, it's this myth. It's almost like this unicorn, the family offices. Break it down for us. What the truth and not the Hollywood speak of what it's like to be on the board of a family office. And for people that might be interested in someday developing the proper deck to get in front of an office, what is the process like? What do you look for when you invest with your family office?
Yeah, so these are great questions, and I want to make sure I get all of them. So your first point is really well taken. And I talk to folks about this a lot because a lot of people reach out saying, tell me your secret sauce to raising capital, which there isn't one. And oftentimes I will tell them, listen, this is a capital intensive business. Raising capital is probably the hardest, most challenging part of the business. And the biggest mistake that I made as an entrepreneur, looking back on it now, was I was looking for a turnkey solution. Always like, oh, if I could just connect with the right family, if I connect with the right group, if I could connect with the right overseas investor, it'd be this golden chalice, right? Like all the doors would unlock and I could just sip my ties. The reality is it's supposed to be hard.
Mm-hmm.
It is supposed to be challenging to raise capital. You have to get a lot of no's. You've got to work on your pitch. You've got to understand your value proposition. You have to really be empathetic with your logical investor base and solve the problem that they have in their financial lives. Otherwise, you will fail. And if you're not the chief sales officer, I'm not interested in investing with you because you need to be the one telling the story. So that's the first one is there is no easy way out here. Family offices are not going to just be this magical solution for you. And half the people on LinkedIn that say they are in one are not. So just stop.
There you go. Listen to that, people.
You have 12 to 15 hours a day where you can be productive if you have a family or want to like be functioning long term. Do not waste it going down this rabbit hole. Mm-hmm. I promise you. That being said, I think another big application of the term or misunderstanding of the term is that a family office is not represented by the number of zeros in the bank account. It's represented by a mindset. There are a lot of ultra high net worth individuals and families that could have a family office if they wanted to, but they don't because they don't want to have that culture. It's just like being an entrepreneur and being a sponsor. You're also running a small business. Mm-hmm. And small businesses are a lot of time, a lot of effort, and they generally fail if they try to extend over multiple generations. So I think the biggest thing for you, if you are interested in networking in the family office space, is understand what their problems are, because just because they have a lot of money doesn't mean they don't have problems. And the issue they're trying to solve is they are trying to maintain a quality of life over an exponentially growing size family with inflation. Mm-hmm. And when you do the math and all that, they've probably got to solve for a 10 to 12% annual return to maintain, right? So it's a very challenging investment criteria, but if you can help them solve that, they will look at your pitch and they will have a real conversation with you and you will get a real meeting. Mm-hmm. But it's not one of these things where you just reach out, they're going to write you $1 million check. And I think that's the biggest misunderstanding is, they are fiduciaries to their lineal descendants and they're stewards of capital, of a corpus of capital for theoretically 3 to 4 or 5 generation plus. And if you can help them execute that, that's great. But not every product type or every deal that you pitch them is going to be a fit. And they're not just in the deployment of capital business. That they didn't get to where they are by making those choices. Mm-hmm. And so I think that's kind of the starting point there. Mm-hmm. And another thing I would add is, my family included, a family office, the biggest part of that term is the family part of it. And families are crazy. They're schizophrenic. They change their minds. They change their lineup. People get divorced. People pass away. They get new executives that come in. They leave. Priorities change depending on who's running the show that year. And so you've kind of got to be communicative and understanding that the conversation you had with one last year may not be the same conversation you have with one this year. And the old adage is, once you've met one family office, you've met one family office.
Mm-hmm. Yeah, it's very interesting. And, the friends that I have and acquaintances that I have that are in family offices, a lot of the times, the people that I deal with, the directors of the boards, the people that handle the real estate are not part of the family a lot of times. These are attorneys or these are people that were in the financial world that have been hired by the family in order to oversee or dispense with just the real estate portion of the family office. So everyone, you're not talking to someone that happens to have, 8 or 9 figures worth. You're talking to, most of the time, very seasoned, very hardened attorneys or financial experts that are hired to not make mistakes.
They're no guys.
They're no guys. They're the no guys, and you have to be extremely good, extremely confident, have and do your research with these family offices. Find out, if you can, what type of real estate that they're getting into, what their end game is, and sometimes they maybe only want 10%, but they're really big into the K1s. They want to see some losses on paper to reduce their tax burden. So whatever they want, but get that deck right. Is that kind of, what you're seeing, Brian? Is it just...
Yeah, and more so than the high net worth space, the entry point is really important. Like how you get that warm introduction and how you get that referral, or what affinity group you met them through, will really be a determinant to how that relationship moves forward.
Yeah.
Which means don't just blind email them or blind ping them on like just don't do that.
Hi, I'm Mike, and I want to buy a hotel. Can I have 5 million?
Yeah. It's it's a long sales cycle, and they would tell you that too. And that's where, if you're willing to put 3 to 5 years in, which is kind of what I've been doing with a group of LPs, it can be great. But it's like meaningful relationships take time and energy.
Yeah. And that's so true. It's a lot of people that I talk to that are sponsors, they don't want that. They don't know about the relationship. And that's so important, because you don't want these people to be one and done. You want them to have a relationship. You want to get that Christmas card, right? You want to be able to have that. And so it becomes a first time deal, then the third, and then the fifth. And that now you are growing together, and you're bonding, and you're able to do this, and both of you succeed. And that's what it's all about. Brian, this has been absolutely amazing. I've really enjoyed talking with you. How can people find you for this next fund or this syndication that you're opening up?
Yeah, I appreciate that question. I'm very active on LinkedIn. So you look up Brian C. Adams, Excelsior Capital, connect with me, shoot me a message. I'm happy to set up a call. And then the website's probably the best entry point to get qualified as an investor, excelsiorgp.com. And you can kind of go through the steps there.
Okay. And everybody, Excelsior's EXCELSIOR Capital. And Brian, I appreciate the time, and thank you for your insight. It's been wonderful.
Absolutely. Thanks for having me.
Take care.